It's another quiet day on what has been a quiet week for financial markets. Not a whole lot on the economic calendar this week, so not surprising that we're idling across the major assets. But we'll take this as an opportunity. It is, of course, the beginning of the second half of the year. So what we'll do is we'll take stock of what happened in the first and go asset by asset of the majors and see. Never mind what the data says, never mind what the headlines say. What does the price action say about what macro narrative and what macro story we need to be telling ourselves as we get into the second half of the year? This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we'll start by taking stock of what has actually occurred. We'll look at just hard performance, no economic indicators on our show today, just looking at the price action. And what we'll do then is we'll look at where all of these moves leave each one of these major assets, and we'll see how it goes for the setups that present themselves for the rest of 2025. So let's start here with this, and I'm looking at it as kind of a scoreboard. In the first column here, we have the second half of the year to date, so call it first half of July so far, essentially. The next column here is what we did in the first 6 months of the year. And for reference, there's a 25-year average. Now, one thing to keep in mind here is that, of course, Bitcoin doesn't have a 25-year average. It hasn't been around that long. And so what we have here instead, looking at that, is a 7-year average. I tried to single it out as far as color coding here to make sure that we're not looking for this as apples to apples comparisons to, let's say, the S&P or the dollar, because of course this is not an asset that's had that kind of a track record, and so we wouldn't be saying exactly the same thing about it when we compare its recent performance to a kind of historical norm. So let's go down the list here. What did we see in the first half of this year? S&P 500 was up 5.4%. Now, for all the fire and fury of wars in the Middle East and the rollout of the tariffs and the apparent sell America kerfuffle where stocks, bonds, and the dollar were falling in tandem toward at the beginning of April, end of the first quarter, going into the second. For all that, the S&P 500 has only gone up a touch more than an average 6-month period over the past 25 years. 3.7% is the average, 5.4% is the gain that we have. Solid, but nothing off the charts. NASDAQ is a similar story, 7.9% gain for it, 5% is the norm, so not exactly soggy, but also not crazy or standout. Certainly good, but not amazingly shocking. No, to go for amazingly shocking, you'd have to look at yields, gold, or the dollar. And of course, there's a special spot here for crude oil, which we'll get to in just a second. In particular, the most interesting thing on the yields front is just how volatile the long-term interest rate structure in the U.S. has been relative to history. The 10-year yield down 7.5% here in the first 6 months of the year, and the normal run is 3.7. So this is almost double the usual move. And interestingly, for all the screaming about sell America and Everybody is fleeing our markets and nobody wants to own dollar-denominated assets. They certainly seem to be willing buyers of U.S. bonds because, of course, when yields fall, what that means is that bonds are being bought. Bonds are up in the first 6 months of the year. Now, again, it's not anything crazy, but there it is. The swing at the front end, where the sensitivity is less to, let us say, longer-term fiscal viability concerns and more so to near-term monetary policy concerns, the story is about easing. And despite the Fed's resistance, we have about a standard size move, 12.1% decline in the 2-year rate so far this year. The average is a 13.1% swing, and it's to the upside. So this is certainly a move out of step with the norm, both in terms of direction and perhaps a little bit in terms of magnitude, but not much there. Certainly that for the 10-year, though. It is almost double the average move and in the wrong direction relative to the average. So there's a clear story in the bonds here suggesting we're not positioning for higher rates or for some sort of sovereign collapse. The Treasury market is being bought, and the markets are betting on Fed rate cuts. We'll put a pin in crude oil for just a second because that is possibly one of the more magical of these numbers, given what the news would have us thinking. But what is certainly a part of a sell America type of narrative is the US dollar. The major alternatives to the US dollar seeing blistering gains in the first 6 months of the year. Gold up 25%. That's huge relative to the average. Euro up almost 14%. Again, huge relative to the average. Yen up 9.1%. On average, the yen barely moves at all. So we have a very clear sell dollars narrative here. Now, Bitcoin is up 15%. Again, asterisk, this is only a 7-year average. A 6-month run for Bitcoin that is normal is 42% over that average. Obviously, it's a very young asset, and this includes periods of immense volatility as a function just of illiquidity alone. Obviously, that liquidity issue has been diminishing with time. Bitcoin has become more and more liquid with the introduction first of futures, then of ETFs. So there's been a significant maturation in these markets. Nevertheless, a drop from 42 to 15 is a significant decline. I just wouldn't necessarily say that you can chalk this up easily to Bitcoin looking soggy, and instead look at this as some combination of momentum cooling and of the asset just becoming more liquid and more mature. And so its up and down swings have, thanks to there being more buyers and more sellers at every level, they've just calmed down some. But there is a story in these numbers, Bitcoin aside. If we take a look at, and before we get into it, we'll look at crude oil here as a last bit. But if you look across all of these assets, one by one, there is a narrative to be extracted. And it isn't the narrative that you might expect if headline reading is your pastime. So, and we save crude oil for last because it really makes this disparity very, very clear cut. We have had all the reasons in the world for crude oil to be surging if you were to read the headlines. The situation in the Middle East has only become more acrimonious. We had Israel strike Iran directly. We had the U.S. join them in striking Iran directly. The situation in Gaza seems no closer to any kind of unwind. And the situation in Russia and Ukraine isn't getting any closer to a resolution either, it would seem. In fact, just this week, the president was bemoaning what Russia is doing, and ostensibly his attempts at peacemaking have been rebuffed. Supposedly, he had a good relationship with the Russian president and thought he could be a vector for some kind of a settlement. Well, that's not occurring. So all of the disruptions that you might have expected to be so worrying for crude deliveries, they give us a net out to a 9.2% decline, which is obviously way off what the historical average of a 5.6% gain is. And that really is a kind of avatar for how one might read this data more generally and say, well, if we ignore the headlines and see what capital is actually signaling with where it's going, what do we need to think about? What do we need to worry about? What is the macro story really if we listen to the price action? Well, crude oil is down when the headlines might think it's up. At the same time, the dollar is down and yields are down across the curve. Okay, if yields are down and the dollar is down, that seems to suggest that the dollar is expected, or the markets are positioning for the dollar to be less attractive as a thing to hold. Okay, that is sort of forex markets 101. When a currency loses yield advantage, it becomes less attractive relative to other currencies. But is this a kind of sell America, everything in the US should be sold that's not nailed down kind of a move? Well, clearly not, because 10-year bonds are being bought. That is to say, the markets are signaling confidence in the U.S. as a long-term borrower, Moody's downgrade, belated though it was, notwithstanding. We're also seeing that at the front end of the curve, as we were just saying, rate cuts are on the menu. And in that context, crude oil being down comes together to say, well, if yields are going to come down, but not for catastrophic reasons, why would they be going down? And why would a cyclical asset like crude oil be going down with them? Why would anti-fiat alternatives that tend to thrive in low interest rate environments like gold be outperforming? Why is the euro and yen looking so strong when their interest rates are lower than that of the U.S.? Well, all of this seems not to paint a sell America story, but a recessionary one. There's some kind of economic downturn in the works. But stocks are up, you might say. Sure, but in dollar terms, they're not, because the dollar is down more. The dollar is down more than stocks are up. So if you were an investor in U.S. equities, sure, if you are a U.S. investor, then the dollar is your currency in which you operate, and you don't see the exchange rate difference. But if you're a foreign investor, let's say, in U.S. markets, you're actually down money because stocks have gone up less let's say for the S&P, 5.4%, then the dollar has fallen 13.9%. So if you made 5.4% on your US dollar denominated stocks, you're actually out money on the exchange rate. So is this exuberant risk appetite? Doesn't look like it. In an environment where the net is for the dollar to fall a little on an average quarter, and for stocks to go up 3.7% on an average, or not quarter, 6-month range, and for stocks to go up almost 4% on the same scale, well, yeah, that makes sense. That makes U.S. markets attractive. This is not that story. Now let's take a look then where all of this leaves us. If the markets are positioning for some sort of economic downturn, where are we across the major assets as we head into the second half of the year? Here's the S&P 500. Despite kind of low percent change values, it is at a record high, nominally, of course, because the way you get those narrow percent changes is you get this wild wick on April's candle. But also what you clearly see is negative divergence in momentum studies. And this is the relative strength index, which is just a basic oscillator here. And what you see is that although you're setting higher highs on the price, you are not setting it on this oscillator, which in pure arithmetic terms, not technical analysis, voodoo, not anything like that, just pure arithmetic. The way that RSI is constructed is it's a ratio of average closes up versus average closes down. So all it's really telling you is whether the price has a propensity to close up relative to down. And you can see that in a normal situation, as the price rallies, it also has the momentum behind it, as it were, to have the propensity to then keep closing up relative to down. So as the price goes up, RSI goes up. Until it doesn't. You can see these divergences, for example, in 2022, where this precedes a loss of momentum that leads into a top. It's a similar story in 2007. It's a similar story in 2000. And so we've seen this movie before. When it happens on a monthly chart, this kind of a loss of momentum can be toppy. We haven't seen it confirmed yet, certainly, but does look like we're getting into some rarefied air as momentum is drifting out of the market. Same story in the NASDAQ. Again, record highs, but we're not matching it, again, in just pure arithmetic terms in momentum studies. So, again, looks like despite what the price action is doing, this market looks like it's feeling toppy and losing steam. After all, this also in 2022 was a record high. But because we set it with momentum fading, only a matter of time before it turned into a year-long sell-off. The situation in bonds is a little bit more nuanced because, of course, we just saw that yields have been going down. And indeed, you can see that here. But the move so far has been relatively modest. And in fact, things have been broadly range-bound after the rate hike cycle that ended at the end of 2022. So as the Fed has idled, so too have yields to a large extent. But certainly there is no sell America panic here. And indeed, since the beginning of the year, yields have come in. This is the 10-year yield future, not the bond. And you can see we're a little bit lower. Not catastrophically so, but what that tells us is, of course, that if the Fed really does start to cut rates, then we have all kinds of room to go. But all of what the headlines would tell us is a reason why bonds should be collapsing and yields should be soaring because confidence in American credit has been lost. None of that is on this chart. It is the same thing with the 2-year yield. Here you can see actually the dovish implications of what the markets think of the Fed are a little bit more obvious. Not surprising. This is more sensitive to immediate Fed policy. And you can see yields are in from the beginning of the year, but they've actually been coming in since the beginning of 2024. And indeed, we got some rate cuts last year to show for it. 100 basis points of them, as a matter of fact. And so we've had a level change in yields. People are buying these bonds. They're expecting easing. The Fed only sees 25 basis points in rate cuts next year. The markets see closer to 70. Again, this is smelling of some sort of an economic downshift that the markets are envisioning, that the Fed is going to have to respond to. Crude oil, for all of the fire and fury on the geopolitical front, has been steadily declining since 2022. So far this year, the net effect of what we've seen is just more downside. Now, we've kind of anchored near what is essentially the former support in this range here, and these long wicks on the monthly chart suggest we tried rallying through them and failed, which again tells you if there's kind of a geopolitical concern here, we'd be seeing something else. In fact, this long wick is a picture of that geopolitical concern failing to be a longer run motivator of price action. So what do we see instead? Well, this is a cyclical asset. If it is sensitive to supply and demand for energy, which is what you might expect, then what this is telling you is that's the thing that matters, because otherwise it'd be rallying, which is yet another little bit in your get ready for recession argument. Gold seems to have the most of its run up at the start of the year and is now idling, but very tellingly is holding its ground, whether the geopolitics improves or doesn't. Obviously, crude oil here has been a story where the geopolitics are being shrugged off. So that gold is holding up here, very clearly not a story about that. If it were, it'd be falling. But it is holding up. What's holding it up here? Falling yields and a falling US dollar could certainly do it. And so again, we get to a place of expectation of a downturn. If surging stocks were a story of reflation and buoyant growth, it might be going higher. But that's not what we're seeing either. This looks more like the standstill that you've seen in bonds in the most recent months, and the upshift leading into it to expectations of a more dovish stance. And of course, this is the US dollar, the dollar index here as a catch-all. We've very clearly shifted out of the range that was there after the rate hike cycle in 2022 that gave the dollar a massive yield advantage, and so it was rallying. We've clearly shifted into a lower setting here. We've broken out, giving us more room to keep going down, it would seem, in general terms. No sign yet of a turn, though certainly if there were a tactical bounce here to retest the underside of this range, that wouldn't be anything shocking. We've seen a pause here. When we initially took out this range, there was an attempted rally that ultimately stalled. Now we've got another leg lower. Maybe we could see another retest and failure here, but the direction seems unmistakable. And in the context of what we're seeing in the yields and them going down and bonds being bought, it isn't a loss of confidence in the dollar as such, but just a bet on relative rates. And of course, here's Bitcoin. And like stocks, we're setting higher highs, but momentum is fading. So if you were going to get some sort of a washout and stocks were telling you that, this seems to be telling you a very similar thing and pointing you into a risk-off concern type of a direction. Now, these are, of course, monthly charts, and the performance we've looked at is 6 months of performance, so actionable this may not be, but it is a useful exercise because it suggests through prices what macro narrative is likely to prevail, at least at this point, going into the second half of the year. It's not necessarily what the news might suggest or even what the data might be whispering at us. And that perhaps makes it the most likely to play out because the markets haven't priced this in to nearly the extent that perhaps they could. That is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am likewise here Mondays and Fridays, including tomorrow, for Futures Power Hour with Chris. Tuesdays for The Price of Truth with Victor Jones. Sunday for First Call with Tom and Victor, writing for the news and insights portion of tastylive.com and commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back next week. Happy trading.